Hey everybody, it's Matt. I want to talk about something that has been on my mind really for years, but it has been more and more on my mind as I watch markets behave somewhat erratically and talk to clients and whoever wants to listen about sort of this thesis I want to lay out about how markets have structurally changed. Stock markets, bond markets, currency markets, derivative markets, like everything has changed over the last 50, 70 plus years, and how we might adjust our portfolios to sort of modernize, so to speak. So this is going to be a long video, and I don't want people who are not interested or to who this would not apply to be stuck watching the whole thing. So I'm going to kind of try and eliminate a significant number of viewers early so you can just turn this off and continue on with your day and not worry about it anymore. So I'm thinking about sort of three different client types that I work with. The first client type is going to be a client that hears this idea and they don't like it, and so don't do it. The third client type is going to be clients that hear what I have to say and they do like it. And what we're going to do as a result of that, if you say, I do like this idea, I want to discuss it further, then we're going to discuss it further, because what I'm talking about in this presentation is general in nature, but I do not get into how we would actually implement it for your specific investment accounts. And what that means is you don't have just a blank slate of cash with which to deploy the strategy that I'm going to outline here. You have existing holdings with embedded gains in them. And so there's going to be tax consequences to changing your strategy. And so for every single interested party, we're going to have a different approach for how we actually implement this. And then finally, we have client type 2 here in the middle, which is, I think, most of my clients that are going to say, just do whatever you think is best. The entire point of me hiring a financial planner and having you manage my money is because I don't want to think about it. I don't understand it. I don't want to understand it. I'm not interested in learning all the mumbo jumbo. Just do whatever you think is best. And that's perfectly fine. What we're going to do in that case is we're going to stick with what we're already doing. We're not going to do something new and exotic, because the thing I'm proposing here introduces new risks to you. It is more expensive than what we're doing now. It's more complex than what we're doing now. And if I don't have absolute buy-in from the client, then there is absolutely no way that I would do it in your accounts, nor should you own things that you don't understand and are not comfortable with. If I think about my client breakdown, I think 80% of my clients are going to fall into this category. And so this is your first off ramp in the video. If you're the type of person that is just saying, look, I trust you to do it, I'm going to hand it off to you, do what you think is best, then we're going to stick with what we're doing, which is keeping fees low. We're keeping the portfolio simple, straightforward, understandable, built for long-term wealth generation through just basic stock and bond ownership, and that's what we're going to do. Then there's probably going to be another 10% that do want to hear what I have to say, but at the end of the day, because of the costs and the complexities of it, they're going to say, I don't want to do it. And then there might be another 10% who hear what I have to say and they say, yes, I do want to do it. Okay, so if you're in this middle bucket, please just stop the video and go do something enjoyable. If you have already heard me say enough that everything I'm about to suggest increases, let me rephrase that, it introduces new risks, it is complex, and it is more costly, and that's enough, that's all you need to hear, you don't want to do it, then you can cut it off. Okay, for everybody else that wants to continue hearing and listening, then let's move on. All right, before I start introducing complex things that are expensive and introduce new risks, I want to reiterate my belief in some core tenets of investing. Number one, minimizing fees and taxes is important. It's not the only thing that you should ever consider, but it is important. Diversification offers a similar return for lower volatility. And in the financial world, volatility and risk mean the same thing. Risk has a very specific meaning in the financial world, and that is volatility. And I really want to highlight this. It's the only thing that's underlined in red, is that your diversification does not improve returns. There is a misunderstanding or a myth out there that the more diversified you are, the higher your returns are going to be. And that is not what diversification does. Diversification offers you a similar return for a lower volatility or risk. So the thing that I'm going to be selling and promoting here is not outsized returns. It is a reduction in volatility for the same expected return profile. Number 3, you need to understand what you own and why you own it. And that's why I'm spending so much time doing this video and educating people on it. It's really important. You should not hand off to some third party, me or anybody else, and just say, do whatever, and have them invest in a way that you don't understand and are not comfortable with. Don't do that. Number 4, paying extra for potential outperformance is a bad bet. Okay, so what I'm not going to try and convince you of is that we need to pay more expensive fund management fees because there's some special wizards out there that can consistently beat the market. That's not what this is about. What I'm going to wind up suggesting is that we pay higher fees to get access to investment strategies that are non-traditional and have not already been commoditized. You should never pay somebody a bunch of money to try and beat the S&P 500 US stock index. That's just not a wise bet to make. But if we can get access to more esoteric hedge fund strategies within a liquid mutual fund structure or ETF structure, then that's something to consider, because there's not a lot of that out there, and they can charge a premium because they're getting us access to things that are not common. Finally, number 5, there is no magic bullet. The thing that I'm proposing here, the stuff I'm going to talk about, is not going to make you uber wealthy in 2 years, and it's not going to solve the world's problems. It's not a magic bullet. I just think it is an acknowledgement of how markets have changed, and it's us adapting our portfolio strategy for decades to come. All right, so let me talk about sort of part of my thesis as to why I want to modernize portfolios, or I think it's a good idea. This is what I would call, the legend is down here. Yellow is the classic outlook for market volatility. You could say this is stock market volatility. You could say this is total portfolio stock and bond volatility. But what I want to try and illustrate is that we all know that things go up and down in value, and sometimes there can be large, significant declines and crashes that are very scary and not fun. Historically, we have recovered from every single one of those crashes in modern history since the Great Depression, including the Great Depression and the crash of 29. And so we're just familiar with the concept that you have to ride out this volatility, and over time, it's our expectation, though it's not a guarantee, that our investments will generally rise in value over time. That's the classic view. What I think is happening, has already started happening really for years, but is going to continue for decades to come. I think the structure of markets has changed such that this line is much more volatile than it used to be. So I realize that's not the easiest thing to see. The green line, the modern experience that I'm trying to illustrate, is the similar idea. We're going to start at this same spot and we're going to finish at this same spot, but it's going to be a much more bumpy ride the entire way. The highs are higher, the lows are lower, and it is extremely not fun to deal with. I'm not promoting an outsized return. Again, same starting place, same ending place, right? But what I'm saying is, in between, over the next years and decades, I think that our investment experience is going to be one of a lot more volatility and nausea, because markets have fundamentally changed in terms of how people can buy and sell. people's institutions' reactions. Instead of selling one kind of stock and getting into another kind of stock, they just get out of stocks altogether. It's a very binary market. It moves very fast. It's global in nature. So we've seen this increase in volatility that I think is here to stay and will continue to come. So that's what I'm trying to highlight. It's a much more volatile ride going forward, in my opinion, and I would like to try and mitigate that and modernize portfolios to account for that. All right, so how do we mitigate volatility? Well, the answer is we diversify, and I want to talk about classic diversification as we know it. So you might think of stocks as having different categories. So there are big companies, there are small companies, there are companies that are considered value companies, meaning that their prices are below what they should be. Maybe they're an underdog kind of company. Maybe they are a dividend-paying company that's been around for 150 years. And then there are growth companies like technology, Tesla and NVIDIA and things like that, where you buy that stock because you're looking for significant growth. And the whole point is everything we ever learned in college or MBA or whatever any books you've read have said that within stock market, the overall blanket stock market, you can use these different types of stocks to diversify against one another. So when big companies that are value companies are going up, maybe large companies that are growth companies are going down, and maybe small growth companies are doing something else, and maybe small value companies once again are doing something else. That the idea is that these all different stocks don't move the same way all the time. And by incorporating different types of stocks, you will diversify your portfolio and reduce volatility. Same concept for bonds. I'm not going to bother with the different types of bonds, but just conceptually, some bonds will move one way while other bonds move another way, while other bonds, move a different way. That's the classic view of diversification. That's within the asset classes. Like within bonds, they diversify one another by owning different types of bonds. Within stocks, they can diversify by owning different types of stocks. The next layer is that stocks as a whole and bonds as a whole should generally diversify each other. So if stocks are going down, generally bonds might be moving in a different direction, either flat or up, and they're serving as diversification at the portfolio level. So there's kind of this smaller micro level where different types of stocks can diversify within themselves, different types of bonds can diversify within themselves. And then when you put stocks and bonds together, you're getting the diversification benefit of those two general structures. So what I think has happened, and what I purport to show you here in a little bit, is that in modern times, everything sort of moves together, particularly in the stock universe. So green is what's going on in modern. When large value companies are declining, often large growth companies, small value companies, small growth companies are declining. And often, frustratingly, what we've seen is that when stocks as a whole are declining, bonds as a whole are declining, or at least not going up. And so what I want to convince you of is that the effect of diversification has been diluted. It's not completely gone. I'm not saying that stocks no longer diversify against bonds and that different types of stocks no longer diversify against each other. But what I'm going to show you is that they don't have the diversification effect. It's not as strong as it was 50 years ago when the textbooks were written and basically the foundation for all air quote modern portfolio theory came about. And so I am going to show that. All right, so I'm going to flip over to a different screen, and I'm going to give you some context on the academic background versus like our lived experience. All right, I'll try not to get too in depth on this, but basically, I just want to convince you that the Nobel Prize, like the basis for modern portfolio construction, is this thing called modern portfolio theory, and it gets a lot of recognition because it should get a lot of recognition. It's based on Nobel Prize winning work in academics by Harry Markowitz, Merton Miller, and Bill Sharp. So this is the Nobel Prize in 1990, and it is based on work that these people did separately. They weren't all working together, but it's extremely famous work. And I think the big thing I want to highlight is this theory analyzes how wealth can be optimally invested in assets. Okay, this theory analyzes how we can make an optimal investment portfolio by including assets that differ in regard to their expected return and risk, and thereby how risks can be reduced. So in English, what they're saying is diversification can reduce risks. That's what this is saying. There's other parts of this. If you want to pause it, feel free to read through it. But I want to convince you that all the textbooks, all the education that any of us have ever received relating to investments has a strong foundation in what's now known as modern portfolio theory. It's Nobel Prize winning work. But the key is, note that the Nobel Prize was given for this in 1990, so 35 years ago, and that the actual work that was done for what they were given the prize for was done even further before that. So Harry Markowitz, his works were in 1952 and 1959. Bill Sharp did the CAPM, and they cite a work here done in 1964. The CAPM is a way to value stocks or really any assets, capital asset pricing model. So if you took a finance class in college, you would have learned the CAPM. 1964. Merton Miller, where do we go? 1958. So what I want to convey and make sure you understand is that the Nobel Prize in 1990, 35 years ago, was awarded for work done decades prior to even that. And imagine if I told you that your doctor is going to be using air quote modern stuff, modern techniques that were developed in the 1950s and 60s, and that the Nobel Prize was awarded in 1990 for it. With the exception of like penicillin, a lot of you might say, geez, I that doesn't sound too modern to me. That sounds a little bit outdated. I feel like the world has changed. And that's what I'm going to try and convince you of here, is that the world has changed from when this was done. There are some innate truths with this that I don't think have changed. I do believe that diversification can offer similar returns for lower risk, but I believe that the market structure themselves have changed such that diversification that we used to get from stocks and bonds is not what it used to be. So how can I prove that to you? Well, what I've done here is I've created just a fake portfolio using Vanguard mutual funds that have a really long track record that can go back like to the 1990s. And I want to illustrate for you how stocks, this institutional index here, that's a U.S. stock index, and let's say small U.S. stocks, how they have grown more correlated with each other, that the diversification effect has been diluted. And I also want to compare these stocks to just like the U.S. bond market and how that correlation, how that diversification has become diluted. So first, let's start with the stocks. So I want to compare U.S. large cap stocks with U.S. small cap stocks. So I'm going to come over here to VINIX, and I'm going to scroll down to the bond, and I'm going to click on this. What this is saying, these are color coded. The darker red it gets, the less diversification benefit you're getting. So this is saying that these two are 88% correlated, large stocks, small stocks. Currently 88% correlated. But we can also look and see how they've been over history. Unfortunately, let me see if I can get this window pulled up. I can't. Hold on. Okay. I wanted to get the years in here so you can kind of see. What you're seeing here is how the correlations between large U.S. companies and small U.S. companies have changed over time, because this 88% correlation metric is not static. It changes. So, for example, in the dot-com bust, where all U.S. large cap technology companies seem to explode at one time in a bad way, implode, the difference between how large U.S. companies behaved and small companies behaved, it increased, meaning that they didn't move together as much as they had been. So the correlation comes down. All right. So right now, if they're 88% correlated, back March 31st to 2000, they were only 33% correlated. So like certain market events can cause things to either become non-correlated or to become more highly correlated. It's not a static situation. But in general, if we go back to the early 1990s and come all the way to 2025, it's hard to tell on this particular chart, but we're starting at 0.8%. And as I go through, you can see we'll be like in the 60s, 70s, 80s. But over time, this has moved higher and higher to the right, such that now we're sticking around in the 90% range, high 80s into the 90s. So what this tells me is that, okay, the diversification benefit still exists a little bit, but it's not nearly as strong as it once was, okay? So that is for U.S. large companies and U.S. small companies. Now, let me compare U.S. large companies with the bond market. And I will take the stock one off. Okay. So once again, we're going back to the early 90s here. And this is how have U.S. stocks correlated with U.S. bonds. And we've been in a period more recently where it's been increasing the correlations. So bonds have provided less diversification benefit than they have in the past. And in fact, I think we can get this chart going back further. Let's see. Never mind, sorry, this is as far back as it goes. But since the early 2000s, correlations of stocks and bonds have varied, but they've flipped from negative, working against each other, to positive, particularly in times of crisis. So this is the great financial crisis. And you can see that stocks and bonds were moving opposite directions of each other when things were going really well. So stocks are rising after the dot-com bust in September 11th, and bonds are basically going the opposite direction, holding them down, so they're negatively correlated. And then when a crisis erupts again in 2008, suddenly stocks and bonds move together much more, which is not what you want. That's not the kind of diversification that you want. Then we have this 15-year period where stocks did really well after the financial crisis, really all the way up to COVID. And once again, bonds were negatively correlated most of that time, so they were holding you back. That's part of what diversification does. They move in different directions, but it's a little bit frustrating that in the crisis period, stocks and bonds move together in a bad way. Then when stocks are doing well for 15 years, bonds can be kind of a drag on them. Then suddenly there's another crisis, COVID, and all of a sudden stocks and bonds start moving together again in a more positive direction. That's frustrating. And now what we've seen is that these correlations between stocks and bonds are much more positive than they've been for quite a long time, really since the late 90s. And this is me trying to say that the diversification benefits between stocks and bonds are significantly diluted. And honestly, if I were to figure out how to cut this chart off like around 2000, you would see the overall trend being that the correlations have generally gone up during this time period. It's kind of interesting to me that the Nobel Prize is awarded in 1990 for diversification, and then suddenly in the mid to late 90s, everything goes haywire on them, and diversification doesn't really work as well. But that is the point that I'm trying to make, is that diversification benefits have been diluted, and I think this is a structural issue that will continue for the rest of my lifetime because markets have fundamentally changed from the way they used to operate, which very, very manual. You had to pay a $500 commission to trade a stock, and you had to call your broker, and it might have taken 3 days to settle, and it was just a very slow manual process. Largely very wealthy people and institutions playing in these markets. And it's not just stock markets, it's bond markets and currency markets and derivative markets and things like that. Whereas nowadays, everything's electronic, everything happens in a split second, and things are much more binary. People are either in or they're out. And I think that's why this kind of, the diversification benefits of stocks and bonds has waned, and I think it will continue to wane over time. Okay, so if I'm right, if volatility is structurally higher, remember that was that first chart where I said I thought stocks and bonds and markets are just going to move a lot more strongly in either direction for decades to come. If volatility is structurally higher and diversification is structurally diluted, what is the solution? Well, there are many solutions. I'm going to highlight two. The first, most direct, easiest, simple solution is to buckle up. You're going to take risk early on in your career and life, and then by the time you get to retirement, you're going to play the hand that you have at that time. Basically, take all of that up and down risk in your 30s, 40s, 50s, potentially into your 60s, so that once you have to start living off of your assets, you're going to basically say, what I have is what I have. It's probably going to be a lot, and this isn't a bad thing to work with what you've got. But you got to get out of that volatility environment once you're starting to withdraw from your investment portfolios to live on. So it's just me saying, look, put on a helmet, buckle up. It's going to be a rough ride. I do believe that stocks are still the greatest long-term wealth building tool that we have out there, and I think that will continue for decades to come. It's just going to be a rough ride. But you can pay very little in terms of investment portfolio fees, and to get just easy access to global stocks and bonds, and you can do it in a tax efficient manner. All the good things we talked about, and there is still some diversification benefits between all these things. It's not that it's completely gone. But this is me saying, look, I think it's going to be a lot more uncomfortable than it has been for the last 15 years, and buckle up. Okay, well, if you don't like that, what am I proposing? I'm going to say to you, probably, hopefully not career suicide, is introduce costs, introduce complexity in the name of getting more diversification. I want to get diversification more potent within your portfolios. And the way to do that, unfortunately, at this time, in 2025, hopefully this will all be different in 2030 and 2035 as things continue to evolve. But now we're going to be introducing costs. We're going to be introducing complexity. And I should say, I didn't write it here, but we're also going to introduce new risks that I will talk about. Okay, this is off-ramp number 2. If you've seen enough and you know that you're not interested, just stop the video and go do something much more enjoyable with your life. Okay, if you're still around, I am now going to make 2 different cases in the rest of this video. The first one is that we should add alternative investments to reintroduce diversification to your portfolio. And the second one, and this is really important, is that I'm going to make a case to you that we should use leverage to make room in your portfolio to add the alternatives in. All right, so let's start with number 1, just adding alternatives in the first place. Okay, alternatives. What are alternatives? Alternative is a catch-all bucket that is way too large. It doesn't really tell you anything. It is literally anything that is not a publicly traded stock or a traditional bond. So investing in corn, investing in Bitcoin, investing in art, investing in esoteric hedge fund strategies where they borrow Japanese yen and own the US dollar, called a carry trade. There are a wide, huge array of things that are not public stocks and bonds, and anything that is not a publicly traded stock or a traditional bond is considered an alternative. Some of these alternatives are gimmicks, in my opinion. Private equity and private credit are two of the most commonly sold strategies to retail clients. 40 years ago, a pension fund might make private investments because they had hundreds of millions of dollars to work with and could literally buy companies as long-term investments. Over time, they have air quote democratized things such that retail investors like us can go buy this. And I'm just here to tell you that private equity and private credit, in my opinion, are both smoke screens, that they're not truly diversifying you relative to public stocks and normal bonds. And in fact, in private credit, I think you're just taking tremendous risk. Some of these alternative strategies are gimmicks. Some of them are legit. And so I've got a note to myself over here. Now it's time to flip over once again, and I'm going to show you some examples of alternative strategies that I'd have you consider. All right, as I give you examples, I'm going to start with the most simple stuff that I think you're the most likely to sort of like understand and follow along with and kind of get, and then it's going to get progressively more esoteric and complex. Gold. Gold is an alternative investment. It's one of the oldest, stores of value in the world. And I'm going to show you later, but importantly, the key thing here is I'm not saying gold is going to make us all rich and that the United States is going to collapse and we have to own gold. That's not the point. The point is gold is low correlation to traditional stocks and bonds. And what I'm trying to solve for is find asset classes that we can invest in that are going to enhance diversification. Gold is a low-hanging fruit, easy one to do. Another one is broader commodities. So this is Aberdeen's. That's how they do their name for whatever reason. They're called Aberdeen. The Aberdeen Bloomberg All Commodity Strategy. And then K1 free means that it's not going to deliver a K1 tax form come tax time, which a lot of clients can feel like is a hassle. So what they're doing is they're wrapping up a lot of commodities into a single investment fund. At the highest level, you can understand like the different types of commodities they own. They own things related to energy. So that's stuff like natural gas, crude oil. That's the ones that are shown there in the top 10. Agricultural products. So not live cattle, that comes later. Soybeans, corn, things that you would find on a farm, okay? Precious metals, things like silver and palladium, although I don't see that on here as one of the top ones. Industrial metals, okay, so aluminum, copper, stuff like that. Livestock, live cattle. So this is a portfolio of commodities, and these commodities in and of themselves are diversified from each other. So the price of oil doesn't really have a lot to do, I don't think, I'm saying this off the top of my head, with the price of livestock. Okay, so these things are going to be diversified in and amongst themselves. And then as a whole, commodities as a bucket, a very large, wide-ranging bucket, are diversified against U.S. stocks and bonds. I'm just scrolling to see if there's any further detail about the holdings, but hopefully you're getting the idea here. Okay, so gold and commodities. Those are two pretty straightforward, in my opinion, kind of easy to understand, alternative investment things that we can add to a portfolio. Now it's about to start getting weird because I'm about to start getting into hedge fund strategies. So, for example, AQR is a fund management company that has a very well-known large fund of funds that gets you diversified exposure to different hedge fund strategies. So The way to think about this thing is it's a single investment portfolio. It's a single fund that you buy as an individual mutual fund. Within it, it owns a bunch of subsidiary funds that AQR also manages. And they're all doing wildly different styles of hedge fund investing. So, AQR's multi-asset fund is a completely different investment strategy than AQR's diversified arbitrage fund. These are different hedge fund strategies. You would have different hedge fund managers running completely different investment strategies. Maybe they are trying to arbitrage between companies that are buying and selling each other, or through different kinds of securities. That one company may have stocks, bonds, convertible bonds, that kind of stuff, and they can arbitrage in the capital structure. Macro opportunities. So this is a kind of hedge fund that is not sitting there analyzing the earnings and profits of individual companies to select the best one. It is looking at macroeconomic trends globally and saying, hey, we think that the Eurozone is going to be better than Latin America, so we want to make a bet on the Eurozone and against Latin America. They can do these large-scale investment strategies that way. Equity market neutral, managed futures, style premia. You don't need to know what all these are necessarily. In some ways you need to know what you own, but in other ways, maybe that discussion can come later if you're actually interested in this stuff. But the point I'm trying to make is this is a single ticker, easy wrapper within which to get exposure to 6 different types of hedge fund strategies. And as always, it is not about me saying AQR is the greatest thing out there since sliced bread and is going to beat the stock market. My point is these things are not diversified within each other. They're not correlated to each other. They are diversified in and amongst themselves. And then on top of that, they are diversified against stocks and bonds. The weirdest of them all, SRDAX, this is Stone Ridge Diversified Alternatives Fund. This thing is also doing hedge fund strategies. It's got $1.74 billion in assets. It's in the mutual fund structure, just like the previous one was. Their big selling point that they put on the top of their fact sheet is that their correlation to the S&P 500 over whatever time period that is 0.01, meaning it's basically not correlated. And same thing to U.S. corporate debt. And that's my big point about why we would want to include this. This thing has, once again, a basket of underlying strategies that are materially different than everything else we've talked about so far. So reinsurance strategies, providing insurance against catastrophes, market risk transfer, which is selling options within the portfolio, alternative cash flow strategy. So alternative lending, this is kind of similar to private credit, which I don't love, but can't throw out the baby with the bathwater. Single family home rentals, again, completely different than public stocks, public bonds, and all the other hedge fund strategies we've already talked about. Things like fine art investment or style premia, which is another thing we can talk about in detail, but certain types of we can break up stock returns into what are known as style premia. It's another really academic popular thing. But the point is, these strategies in and of themselves are diversified against each other, and then especially against stocks and bonds, they are really diversified. So those are my examples for adding alternatives into a portfolio, and then what is the result of that? Okay, well, we're back to these correlation matrix. If you remember when I started, I was showing you these Vanguard funds to illustrate how stocks have become more correlated amongst each other and how stocks and bonds in general have become more correlated, and there's a lot of red. This, if you are a nerd like me who just spends Friday nights building portfolios for fun, this is like the most beautiful thing I've ever seen. So what I want to highlight here is something like VT is the Vanguard Total World Stock Fund. How does this thing correlate with commodities? 17%. BCI is that commodity fund we looked at. How does it correlate with global bonds? 64%. So this is one of those red things, and it's kind of to the point I was making earlier. Global stocks, global bonds, not terrible. That's decent diversification, but it's higher, than the other ones. How do global stocks correlate to gold? 0.02. Basically not correlated. How do global stocks correlate to the first hedge fund strategy, mutual fund that I showed you? 15%. Awesome. We'll come back to RSSB, but basically this is the fund that I want to use to employ leverage. This is a stock and bond fund, so you would expect it to be highly correlated to stocks, but it's a tool we can use to deploy leverage to make all this work. I'll come back to it later. Then the fine art esoteric hedge fund strategy that had all this like reinsurance and option selling and all that kind of stuff. Global stocks correlate to that at basically zero, negative 0.02%. So this to me is just amazing, right? Because I'm trying to get you more potent, real diversification in a portfolio. And when I look at, have I found a good selection of investment asset classes, I think I really have. I want to keep you in global stocks. I want to keep you in bonds, but I want to add in diversifying commodities, diversifying gold, diversifying hedge fund strategies, and diversifying hedge fund strategies. This is what I would say is really serious diversification that I think can be very beneficial. All right, so that was my pitch for why you should use alternatives. Now I want to make a pitch for why you should deploy leverage in the investment portfolio in order to make all of this happen. So let's think about a classic 60% stock, 40% bond portfolio. If you've ever heard of portfolio diversification and how people achieve it, this is sort of like the gold standard by which everybody goes by. A 60% stock portfolio, 40% bonds. It's supposed to be. It is. It's not that it's supposed to be. It is a great long-term wealth generating portfolio over decades, or it has been. If we want to add alternatives to this, we have a problem. We have to take money away from stocks and bonds to make room for alternatives. So in this example, if we want to have 20% of your investments in alternative investments, by sheer cold math, we have to take money away from stocks and take money away from bonds to give it to alternatives. And remember, this entire time, I've been reminding you that I'm not pitching you that alternatives are going to be some grand slam home run that's going to make you rich. I'm pitching these as a diversification tool. If I believe, which I do, that stocks are going to still remain as the long-term drivers of wealth for decades to come, I don't want to take away from stocks and add to alternatives, which I'm not pitching these as a major return driver. I'm pitching them as a diversification tool. I've never liked this trade-off, and that's why I've not been a big proponent of incorporating. It's one of the numerous reasons I haven't been a big proponent of incorporating alternatives on top of the added costs and the added complexities and all that kind of stuff. I don't want to have to sell off stocks, which I think are the long-term driver of returns, or even bonds. That's not an attractive proposition to me. So yeah, this is a no. That's supposed to be a circle with a line through it. Like, no, don't do this. Don't sell off your stocks and bonds to make room for the alternatives. Instead, I want you to consider using leverage to make room in the portfolio to add the alternatives in. So let's think about a house. A traditional home purchase might look something like this. You put down $200,000 to own a $1 million house. You've put a 20% down payment on a home. That gets you full notional exposure to $1 million by way of a mortgage. You have you put down $200,000. You have an $800,000 mortgage. This is leverage. You have 5-to-1 leverage in this scenario. You've used $200,000 to get full notional exposure of $1 million. So if the value of the house goes up from $1 million to 1.1 million, you've made $100,000 in profit. That profit is yours. You've made $100,000 in profit. You only laid out $200,000. So if you look at your cash outlay, you've made a 50% return. That is leverage. Leverage works in both directions, and it can be very not fun also. What if the value of your home goes down by $100,000? Okay, well now you still have that full $800,000 mortgage. They don't reduce the debt you owe because the value of your home has gone down. So you have now an asset worth $900,000, or you've lost $100,000 on your $200,000 investment. So you're effectively down 50% on your investment. Leverage magnifies returns in both directions, and because of that, it can be very dangerous and unwieldy, and it's a risk that I want to highlight because, like I said earlier, there's no magic bullet, and I am going to be introducing new risks as part of what I'm recommending here. But a key component, a key point of why America is so comfortable with the mortgage process for a house is because, one, it's the only way a lot of people can afford to get into a house in the first place. And number two, it allows you to go invest the $800,000 that you didn't use for the house outside of real estate. Again, go diversify. Go take the money that you saved and didn't lock up in the home and go use it for other wise investments that can diversify you beyond just the real estate that you have locked up in your house. Okay, so now let me translate this to stocks and bonds. Okay, I started with a mortgage because I think Americans are generally comfortable with the concept of a mortgage. They don't blink, they don't think twice about leveraging and whatever. Okay, well now I want to say, instead of leveraging a house or leveraging to get exposure to a house, leverage your stock and bond portfolio to free up money. So how would this look? Well, instead of investing $200,000 to get $1 million of home exposure, the thing I'm going to suggest to you is you invest $500,000 to get $1 million in exposure to stocks and bonds. So this is 2-to-1 instead of 5-to-1 leverage like we discussed with the house. Then we're going to use that $500,000 that we don't put into stocks and bonds. We're going to use that remaining $500,000 for something else, which is those diversifying alternatives. Now, importantly, I just want to highlight this, that if your $1 million of stocks and bonds declines to $900,000, that is a problem for the fund. It's not a problem for you directly. You don't ever owe any more money than what you've already put into it. But the fund itself could face a margin call. What does that mean? Well, they had 2-to-1 leverage. We gave them $500,000. They turned that into $1 million in exposure using derivatives. If it drops to $900,000 in value, the equity is now $400,000. We gave them $500. We lost $100, so we have $400. The equity is $400 on a $900,000 value portfolio of stocks and bonds. So if our equity needs to be half of the value, our equity needs to be $450. So $400 is too little. There's what's called a margin call, and the fund would need to come up with another $50,000 to stay at the margin requirement. So what that means is the fund would be forced to raise cash by selling holdings of stocks and bonds. So how do they buffer that? How do they reduce that risk? Well, they introduce a second risk, which is cash drag. The fund, when it deploys leverage, is going to hold back a decent amount of cash to use as collateral to avoid these kind of margin call situations where they have to sell stocks and bonds to raise cash in a bad market environment. So there's always going to be a cash drag in a portfolio or in a mutual fund that, an ETF that deploys leverage. The fund is going to keep cash buffer on hand for collateral that's not being invested, and therefore that's going to be a drag on returns. And then if things really go bad in the markets, every single day the fund has to true up its margin account. And so it is within the realm of possibility that in a very fast moving downward market that occurs in the course of one day, that there could be margin calls and that they would be forced sellers in a bad environment. So, does that all sound terrible? It does. And I'm just trying to be as transparent as possible. These are the risks that I was talking about, that I'm going to introduce risks to the portfolio that were not previously there when we talk about using margin. I think these are acceptable risks, and that's why I'm making this presentation. But nonetheless, these are new risks, additional risks that were previously not part of a standard investment portfolio that you need to understand and be aware of. Okay, so I've made my pitch for adding alternatives, which was probably a well-received pitch, and I've made my pitch for deploying leverage, which was probably not a well-received pitch, but I just want to be ultra transparent about risks and not BS anybody about having found some magic bullet or something. Okay, so let's put those two things together. If, let's say, we want to build $1 million portfolio that is 60% stocks and 40% bonds. So we're going to have $600,000 in stocks, and we want $400,000 in bonds for our hypothetical portfolio. Okay. The way that we would do this with alternatives is, the first thing that I would do as the advisor, portfolio manager, is I would go put $400,000 into this ETF that I referenced earlier, the one that we're going to use to deploy leverage. And the reason I would do that is because it gives us 2-to-1 leverage for stocks and 2-to-1 leverage for bonds, which means, okay, we've given the portfolio, the ETF, $400,000. $200,000 of that is towards stocks, $200,000 is towards bonds. But since it's 2-to-1 leverage, we actually have $400,000 in stocks and $400,000 in bonds. Pause it, rewind it, whatever you want to do to follow that. But you give the ETF $400,000. The ETF is split evenly between stocks and bonds. So you think of this as $200,000 in stocks, $200,000 in bonds. It then deploys leverage and doubles those exposures. So you have a notional $400,000 of exposure to stock and $400,000 exposure to bonds, even though you only invested $400,000 total in the portfolio. What does that do for us? That completes our bond allocation. We had $1 million portfolio. Through this ETF, we have $400,000 of bonds. We've got our 40% bond portfolio. Now, it doesn't complete our stock allocation because we need $600,000 in stocks. Well, we only have $400,000 in stock exposure through this levered fund. So we need to add more stocks. So we're going to do that by adding $200,000 directly to stocks. So this is not anything levered. This is just a traditional low-cost ETF, $200,000 in stocks. Now our stock allocation is completed. We have outlaid $400,000 to this fund, $200,000 to this fund, so $600,000 total. Yet, because this fund is levered, we now have our complete $600,000 in stocks and $400,000 in bonds, and we've got this entire bucket left over by which to diversify. So we have $400,000 remaining of our investment dollars to put towards alternative investments. So this is how it looks. You've got 40% in alternatives, 40% in bonds over here. This fund gives you 40% of your stock exposure, and then we've bolted on another 20% in low-cost index ETF stocks to get our full 60% stock exposure. Does that have the notional? Yeah. So your notional, you've invested $1 million. Your notional market exposure, stocks, bonds, and alternatives, is $1.4 million. And critically, you retained $1 million in stocks and bonds, which was our original goal. The whole key here is that I haven't had to reduce your stock and bond exposure to make room for the alts. I have introduced cash drag risk and margin call risk, but those are at the fund level. You personally are not on the hook. You'll never owe more than what you invest into the fund. What I'm trying to say is that I believe that this is an acceptable trade-off to get the diversification exposure that we want with these alternatives. So that's the end of the slide presentation. I guess let me bring Quanti, my tool, back up. This is what that portfolio would look like. Here is the 40% allocated to the levered strategy, RSSB. Then here's the 20% allocated to cheap global stocks to true up our stock exposure. Then we have 10% each to gold, commodities, hedge funds 1 and hedge funds 2 to get our 100% exposure. And what I think, among the many things that I think are cool about this, number one, again, the correlation matrix. Just these things are really low correlated to each other. When we look at how they're correlated to other markets around the world, it's the portfolio would be 88% correlated to global markets. But you got to scroll down all the way to the S&P 500 down here, 82% correlated to the S&P 500. A traditional 60-40 portfolio would be much higher than that. So it's like doing the job that we want it to do. What else is neat about this? Well, here is a traditional 60-40 blend of stocks, 60% stocks, 40% bonds. This is a third-party software that knows nothing, has no affiliation with that levered fund return stack global stock and bond ETF. Yet it can look through at the holdings and understand that we have 60% in stocks, we have 40% in bonds, and we have 40% in alternatives. I think it's really cool. This pie chart in and of itself is showing you 140% total exposure by deploying this strategy. What are some risks? Okay, complexity is clearly a risk. I'm sure that some people, if you're watching this, your head may be spinning already. Complexity is a risk. Understanding what you own. Frankly, I don't think a lot of my clients, everybody has the capacity to. I don't think very many people have the desire to understand what each of these hedge fund strategies is. And I don't think everybody has the interest. Everyone has a capacity. I don't think a lot of people have the interest to understand what all these different hedge fund strategies are in this one. And so there's this trade-off of knowing what you own and why you own it. And the way I would say it is, you own a bunch of diversifying alternatives for the purpose of diversification. That's what you're doing. Gold, you can understand. Commodities, you can understand. Hedge funds, you just need to think of them as investment strategies that are completely separate and apart from anything to do with traditional stock bond investing, and that's why you own it. Finally, and certainly not the least important, we're going to increase costs if we do this. So what are the fees on a portfolio like this? Well, the fund expenses all in combined are over 0.5% in this example. And that is largely driven by these hedge fund strategies. So if you're seeing this and like choking on your drink or something, I don't blame you. This hedge fund of fund strategies is expensive. It costs over 2% in annual fees. That is very expensive. Now, of course, we're not allocating 100% of our portfolio to it. We're allocating 10% in this case. So that 2.13% is wildly expensive, but in terms of like its contribution to the portfolio, it's contributing $213 on a $100,000 on a is that 100,000? Got to think about that. Yeah, $100,000 portfolio. Okay, so the other hedge fund of funds is at 1.27%. So these two things are very expensive. If you were not my client and you brought me a statement with investments with these kind of fees, I would definitely think your advisor is trying to sell you something expensive because they're getting paid a lot to sell it to you. I don't know what to say about it, except for in my case, I sell zero products. I get zero commissions, no kickbacks, nothing. I have no economic interest in this. It's just, I would hope somebody would give me the benefit of the doubt, but probably I'd have a hard time giving somebody else the benefit of the doubt. And I just want to acknowledge it. These are expensive funds. We're allocating 10% each to these, and as a result, it increases our fees, higher than what I would like to see. I do hope that over the next decade, these strategies become more and more commoditized, more and more people offer things like them, and they'll have to get into a fee war and reduce fees. But right now they're expensive. The fund that uses leverage is expensive. It's 40 basis points. The commodities fund is 26 basis points. Gold is cheap. It's 9 basis points. Global stocks is cheap at 6 basis points. Global bonds are cheap at 5 basis points. So I just want to be super transparent about it. My basic portfolios that I run for people that are just traditional low-cost stock bond ETFs, the all-in costs are generally less than 10 basis points. This is a benchmark. It's not my actual model. The benchmark itself is 20 basis points. Mine are even cheaper than that, significantly cheaper than that. So to deploy the strategy that I'm talking about, we're talking about a meaningful increase in fees you're paying to the investment managers, which is a drag on your returns. And I want you to have eyes wide open, full understanding that that is the case. That's what I'm pitching to you. So I guess in conclusion, if you're seeing all this and you're thinking, hey, look, I get the concept, I get the idea, but I'm just simply not willing to pay that much in fund fees to get this, or I'm simply not willing to own things that I don't really understand what they are, then no offense taken. I totally get it. No problem. I can have comfort knowing that I've presented the concept to you, and I've done my job with that. And if you're thinking, wow, I do like this idea, then I want to talk to you about it individually, because actually making all this happen would involve selling your existing holdings and potential tax consequences of doing that. And also, I just need to make sure I talk to you to get myself comfortable with your understanding of complexity and added costs and all that kind of stuff. So yeah, that's what I think we need to be doing to modernize portfolios. If you're on board, great, let's talk about it. If you're not on board, that's completely fine. Don't worry about it. No offense taken. All right, thanks a lot.